Howdy, Jacob here. Today we're looking at Dell Technologies, 72.1 billion market cap on 85.4 billion enterprise value in the technology, hardware, storage, and peripherals industry. Dell and Hewlett Packard, HPQ, really got a biopoly in my perspective when it comes to computers. I know there's the Google notebook, or maybe that's the Microsoft notebook, whatever. There's like a Google computer, a Microsoft computer, but um, I know that I'm using a Dell currently. I know a lot of people that have HPs. So I think that they really have a dominance in hardware for computers. And when you look at their revenue, it's actually down from 2 years ago. And I think HPQ is a similar story. I might do a quick comparison. I'll probably do HPQ down the line, but might as well do a live comparison here. So we do see revenue down for them about 15% in the most recent year and 14% for Dell. Their gross profit is 20 to 25%. For HP, it is 18 to 22%. So Dell does have a little bit higher gross margin, and the operating margin recently 4 to 6%. HP is a little bit higher on the operating margin side, so it looks like their R&D, sales, general and admin, and other expenses, other operating expenses are a little bit less than Dell. And looks like they both pay a dividend, $1 in relation to 34, $1.48 in relation to 105. So there's definitely a lower yield for Dell. Dell's yield is about 1.7%. HP is a bit higher, but that's not, these are all just statements. So return on invested capital is pretty solid, 12% in the most recent year. However, HP is 36%. And so that's an interesting fact. The net debt is about 13 billion for Dell and is about 6 billion for HPQ. But again, Dell is much bigger. Their income statement shows R&D spend of 2.8 billion in relation to 88 million is 2.8 88 is about 3%. So 3% of revenue is an expense of R&D, and for HPQ their R&D is about 1.6 in relation to 54, and it's a very similar R&D spend. It's about 3%. So both of them are reinvesting pretty much the same amount into the business to take money away from today to possibly get more in the future. And from share repurchases, Dell is actually pretty flat from 10 years ago. HPQ is down from 1.8 to less than a billion shares outstanding. So HPQ has definitely been buying back more shares, which makes sense why their return on invested capital is much higher, because when you buy back shares, that decreases your denominator, making the ratio appear to be a bit wonky. Now let's look at the balance sheet. Balance sheet for HP is about 3.1 billion with 9.2 billion in long-term debt. And for Dell, we have 7.4 billion in cash with 19 billion long-term debt, 6.9 billion short-term debt. I don't like when they have that much short-term debt, but I'm fine with it because they have as much cash on hand to write off that short-term debt. But for me, I don't like debt getting to short-term. So obviously when you have a 5-year debt, you can pay it down a little bit or you can refinance. I don't really like it to get within a year, and it looks like they've consistently let it get within a year. So that's not something that I really enjoy, but their debt is down quite significantly from 7, 8 years ago. So less than half. So we're feeling good about that. From a cash flow statement, they are investing 3 billion in capex. So that's just to keep your business alive. And then also powers and plants do go into this. So if there is expansion, it does show in the capex line. And they make 8 to 10 billion in cash from operations. HP makes quite a bit less, but their capex is much less. So the capital expenditure is about 600 million in relation to the almost 3 billion of Dell, but their cash from operations of Dell is almost double, or yeah, pretty much double. And their reinvestment for HP has been historically share repurchases, uh, a bit on dividend as well. And so if we were to look at the last 10 years, you're probably looking at about 30% to maybe 25% to dividend, 35-40% to share repurchases, 20% to acquisitions, the rest reinvestment and debt paydown. And for Dell, majority of their money is going towards share repurchases as well. So a similar story, not quite as much, but we are probably looking at about 20% share repurchases. The dividend more recently is going to be maybe 15, 10 to 20% there. Debt paydown's been a significant portion. So debt paydown's been their largest portion of capital allocation. And now their free cash flow to debt, if we add up their short-term and long-term debt, you're looking at about 26 billion. And so if you net out the cash, you're looking at about 20 billion. That's not a huge concern in relation to the money that they make. I think conservatively, we could say they make about 5 billion, 6 billion a year, which is going to be less than 4 years to pay off that debt. And so if they do keep paying down about 2 billion a year, that's going to be comfortable at the end of 7 years to be about a 2 times or 2 years of free cash flow. And that's saying the flat free cash flow over the next 7 years. And so I think we're ready to start making some assumptions. I hope everyone enjoyed the comparison. Again, you're just comparing numbers, so there's nothing to say yes versus no. Everything comes down to the valuation in my perspective. So the revenue growth for Dell, I think they can grow. I think it's in an industry that is challenging. The hardware portion is challenging, but I think that so many businesses create new software that they kind of need new hardware to be able to sustain that software. And so I do think they will be able to grow with inflation. I definitely do. I think although they have a biopoly, they definitely have a lot more debt than cash, or a lot more debt than cash, meaning that their enterprise value is about 15 to 20% greater than their market cap. Their enterprise value is 15 to 20% greater than the market cap. So I'm going to put them at a 13p price to free cash flow. For margins, they've been fairly high, but they've also been dampened recently. I'll probably go somewhere in the lines of a 5 to 6. I like that their free cash flow is much higher than their earnings. And then their share change, they are buying back a lot of shares. 700 million is 1%. So 3%, 2% would be about 2.1, 2.2 to offset stock-based compensation, which to them would be about 40%, 30 to 40% of free cash flow. I'm comfortable with that. With the dividend, it's new. I don't want to increase it. I don't really want to increase it. Maybe I'll increase it 2% or so just to say that they increased it. But this is assuming maybe 10 to 20% of free cash flow goes towards debt paydown. We're assuming 30 to 40% to share repurchases, keeping the same dividend with the rest going towards reinvestment and acquisitions to make 3% a year and to keep these margins. So maybe I'm being a bit conservative with these margins. I think if you understand this business a lot better than I do, and you know that they can get back to that 8%, I think you're going to be a lot more confident in this analysis. But for me, I'm not entirely sure, if they're able to sustain that 11, 10% margin, 8% even. And so I feel pretty confident with these assumptions, pretty comfortable to where I'll be waiting for it to drop roughly in half before you get the return I'm looking for. Either way, I hope you enjoy the video and have a great rest of your day.